Let's start by talking about some profitability ratios. And the first one is gross profit margin. And as you can see from the slide, it's calculated as your gross profit divided by net sales. So we've taken two numbers from the income statement for this one. And net sales just means your sales net of things like trade discounts, bulk purchases, taking account for returns, things like that. And this is why this metric is important. Because gross profit is really what's left over after you cover direct materials and direct labor costs, or COGS, which is cost of goods sold. So the amount of money left over needs to be enough to also cover any additional expenses such as overheads, advertising, even taxes, things like that. And as an example of how to interpret this ratio, gross margin of, say, 20% means that after every dollar of sales, you have 20 cents left over after paying for those direct materials and labor. And as we said, you need to use that 20 cents out of every dollar to pay for things like advertising and other overheads, and hopefully still have something left over for profit. Remember too, when you see a gross margin number, it's not talking about volume necessarily, at least in terms of units. So you could have, let's say, a 30% gross margin or a 50%, why not, gross margin, but you've only sold 2 units. Another profitability metric, return on sales or net profit margin, ROS. And this is an indicator of the overall profit performance of the company. And you can see how it's calculated. So it's after you've taken out all your direct and indirect expenses and you compare that to net sales. So as an example of interpreting this ratio, if you had an ROS of 7%, that means you've got 7 cents in net profit after taxes for every dollar of revenue. And is higher always better? Well, higher is nice, but what if you've achieved a very high profit margin due to some unsustainable activities of the company? For instance, what if you're not doing enough research and development for the future? And that's adding to your profit margin, sure, because R&D is an expense, but you're not positioned for the future. What if you're not paying salaries that are high enough? That's going to be a problem. Marketing, the same thing. I can save money by not investing in marketing, but I got to think about the implications of those kinds of decisions. I could also raise prices, would be another lever I could pull to manage this number. If I just raise prices that I'm charging customers relative to my expenses, what's the downside? Well, if customers feel they're being charged too much, they're just not going to buy from you. Another metric that we can talk about, return on assets, ROA. We talked about this one a little bit in the intro. How the company is using the assets of the business to generate profit. If you had an ROA, return on assets, of 5%, you're generating 5 cents in profit for every dollar of total assets that you've got. That's the way to interpret this number. And generally, sure, you'd rather have a higher ROA. You want to think about using your assets well to generate profit. You don't want assets that aren't being used correctly or adequately to contribute to profit. But what if you're overworking your assets, your machines, your tools, your factories, to drive a very high ROA? That's a problem down the road because you may have unexpected maintenance or replacement costs, making that high ROA a Pyrrhic victory. Because you think about what goes into total assets, it's not just factories, not just inventory, it's also cash, it's accounts receivable. So this begins to be a very broad metric that gives an indication of how you're managing not just your fixed assets, plant and equipment, but also some of those current assets as well. And here's a case, as I mentioned earlier, that you want to be wary about comparing ROA numbers across industries. We use the example of a heavy construction company. You look at their ROA, they have a lot of trucks and inventory and equipment. If you compare a company like that to, say, an insurance carrier that doesn't have a lot of factories and things like that, you're really not comparing apples to apples. You've got to think about what kinds of insights you're getting from that comparison. Our next metric, EBITDA, or operating profit, and it's earnings before interest, taxes, depreciation, amortization. So it's about the profitability of the core operations of the business before you take out corporate level overheads like interest that are really determined by your capital structure, your financial strategy. Taxes, again, are about your firm kind of minimizing the taxes that you pay while still being in compliance with all the laws and regulations, but trying to minimize taxes, depreciation schedules at a corporate level of your tangible assets, and amortization for your intangible assets. This metric is meant to get to the fundamental profitability of the elemental reasons that the company actually exists. Our next metric is ROE, return on equity. And this ratio shows how the capital that's been contributed by shareholders and also capital that's been retained in the business, retained earnings, is being used to generate profit. And it's a pretty important metric for publicly traded companies, really any company. And a lot of investors, obviously, and analysts would look at this metric. And you see how it's calculated net profit after taxes divided by total shareholders' equity. So if you had an ROE of 12%, you're generating 12 cents of net profit for every dollar of total equity that the owners of the company have invested in the business and kept retained in the business, as opposed to taking out a distribution or a dividend. And we're going to come back to ROE in another video when we talk about the DuPont model or the strategic profit model for determining ROE. But for now, that's it for profitability ratios.